Welcome to the Stash Cast, where innovation meets real estate. Let's dive in.
Vidar, thank you so much for coming to join me today. I really appreciate it.
Thank you for having me.
We had a conversation a couple of days ago, and you shared a little bit about your past and what you've done, and I thought it was pretty impressive. But for the folks at home that haven't had a chance to get to know you, why don't you give us an idea of who you are and what you do?
Sure. My name is Vidar Hokstad, and I'm a Norwegian technologist, basically. I've been doing startups mostly since I was 19, and I'm 50 now, so it's been 31 years. And I started out basically by leaving university to found an ISP because we thought internet connection at university was so much better than what we had at home and wanted to change that. For some reason, I liked it and kept on doing startups after that. That has become what I was doing. I was actually originally planning on going into academia and researching computer science, but decided this was a better path to take.
So that just seems like such a foreign concept to me, to be like, hey, the internet here at school is much better than what we have at home. Like, how did you do that?
Stupidity, first and foremost. I think part of it was that we had no idea how hard it would be. You're young, you think you can do anything, and we managed to do some quite impressive things, I think, but we had no idea what it would mean to run a business. And we had to learn very quickly. We had to run a business very lean because we got an investor because one of the guys that I co-founded this with, he was a bit older. We had gone back to university to get a computer science degree. And he liked to go to fancy bars. And one night he started talking to this guy about what we were doing. And it turned out that this guy had just moved back to Norway, had some money, and was looking to invest. So we got like a $40,000, $50,000 investment.
Yeah.
And had to make do with that. It's a crazy small amount to start a business with, even more so a business that required physical hardware and equipment. But we managed. But we had no idea how to do it. And so I had to pick up everything from scratch. And I think if we had known how much work it was, we probably wouldn't have. And this is one of the interesting lessons I've learned, I think, is that don't overthink your startup. Don't do some research because you will start convincing yourself that you can do this. And a lot of the time, everybody else has to learn the same things anyway. You might also come into things with preconceptions if you spend too much time learning about it in advance. So we did a lot of things that were very lean because we didn't know better. And got away with a lot of things that way.
You said something that kind of sparked my don't overthink it.
Yeah.
What do you mean by that?
I think one of the things is that if you'd ask somebody from, say, the incumbent telco, was our biggest competitor when we launched, how to set up an internet provider, they'd be like, oh, you need to get this big expensive Cisco router, you need to get these big servers, you need to set up interconnect. We set up internet provider by getting a cheap, expensive for the time, Intel PC and a serial port multiplexer and a bunch of consumer modems. And then we called the telco and said, oh, we need 60 lines to this building that there's been no planning to have that kind of capacity for, and just expected them to do it. They had to because they were bound to by the licensing terms to provide lines, but they were not happy about it. They actually ended up slinging a cable up in the trees for like hundreds of yards from a nearby exchange because there wasn't enough capacity in the building. And we got away with that because we didn't know better. We knew enough to figure out how to make this work, but not how you would typically do it. And I think sometimes you need to know that you can make it work, but you don't necessarily need to worry too much about what's the proper right way of doing everything. We weren't a multi-billion-dollar company.
So the building that you had the lines run to, was it like your dorm or something?
It was actually, we rented office in an apartment building where there was an office in the basement.
Yeah.
And we actually ended up moving in there, even though we weren't technically allowed to live in it.
Long hours.
But yeah, there was the reason actually where they had to fling the cables through the trees was that this was actually a building in the embassy area of Oslo in Norway. And the embassy area was one of the first areas that got phone connections in Norway. And the exchange pretty much hadn't been upgraded since. So it was an ancient exchange with far too little capacity because it was built first. It was the wrong place to put an office as well. If you had spent time researching that, we probably would have ended up somewhere more expensive. Now, we made lots of mistakes, and I learned lots from those mistakes as well. But I think what wasn't a mistake was going into it, not overanalyzing everything, not spending a year planning this out, and not buying the expensive equipment. I think one of the biggest mistakes we actually did was buying more expensive equipment than we should have.
How did you go about acquiring new customers?
That was an interesting one. We started a price war with the biggest incumbent, which was actually another mistake, but it did bring us customers at first. We undercut them by about 75%. The interesting thing is that price point would have worked for us if they hadn't dropped their prices by 75% to about 3 days in. One of my biggest lessons from that whole debacle was basically understand why your competitors are priced the way they are and be careful about how much you want to cutting them. Because in this case, we went into it really naive and we're thinking, oh, we can price this low. It's possible. And it was possible if you didn't account for the customer acquisition costs that we would have once the incumbent matched our pricing. As long as we were able to actually win customers on the basis of that price alone and not have lots of marketing costs, it was great. The biggest mistake we made there was thinking that their price was that high because they couldn't match the lower price and not because the margins were insane. This was internet at the time, 1995, a luxury for people and not something you usually had at home. It was relatively normal for people to have maybe one dial-up connection for a business, and that was it. And that was their market. So they were thinking, oh, okay, this is the mass market thing. We will take a huge markup on it and make our money that way. We went in and was thinking, oh, let's mark up this from 20% above cost. And that'd be a great margin. Only they had millions in capital and they could afford to just drop the price and not make any money off this for a long time once they saw actually that if you drop the price, there's a huge untapped demand there. Mm-hmm. So we served as market research for them effectively and sparked the price war, and nobody really made any money on the dial-up services for the next 5 years.
So you went and poked the gorilla.
Yes.
Or poked the bear. So I guess you find yourself in this kind of, what have we done sort of position.
Yes.
So tell me how the story ends.
It ended okay. I have done 6-7 startups. I don't regret having done any of them, including this one. Basically, what happened was that we refocused to sell towards businesses and use the dial-up mostly as a marketing opportunity. People know our names from that. We got some press and so on. And then we started selling design packages and started hosting for businesses. And then we ended up selling off our dial-up to a company called IDG New Media, which was actually a subsidiary of PC World in Norway. So we sold off the dial-up bit, got office space for next to nothing from them, and was hired to manage it for them. And once we then bought out our investor's lawyer actually then had us into a company run by another client office.
Oh, wow.
Yeah, that was actually another startup, a little bit bigger. They had gotten VC capital. That's how I started seeing that somebody had collected a huge amount of money from Merrill Lynch and other large investors. That was an interesting one as well, because I got to see the mistake of spending too much capital on hardware magnified by a factor of 100 over what we had done.
What was that new business that you then found yourself in?
So that was conferencing and unified messaging. So voicemail and email combined with a conferencing solution, which was unique for its time. You could use a web interface to set up a conference call. And nobody did that at that point. But the big issue was that the people who started this were ex-MCI and AT&T people, and they were thinking as if they were running a big telco. So they designed this platform, which was great. It was only that it didn't scale down. The smallest deployment was a 20,000 line switch. They wanted to deploy like 100, 150 of these worldwide, including 20,000 line switch in a market like Norway with 5 million people. you need to take a very large chunk of the market to sell 20,000 simultaneous people in phone conferences in a country with 5 million people.
Yeah, that seems like an aggressive solution for the
It
market.
was very aggressive. And yeah, so they were banking on an absolutely insane growth level before they had even tested it out in the US.
So you found yourself running this company.
I was certainly not running that one. And so we were hired into the tech side of that one. And so I just got to observe that side. Thankfully, I was not part of making the decisions of buying those switches. They spent 10, 20 times as much on a single switch as we had spent on the entire company in my previous startup. But I could quickly tell what direction that was going when at one point I overheard the CEO was visiting a Norwegian subsidiary, and he was running down the hallway in the office while shouting obscenities at the Merrill Lynch investors. I was like, okay, if you're treating your investors that way, this is not going to last.
Right.
Interestingly enough, I shortly afterwards was asked to join another startup by one of the VPs at the company I was working at. He was leaving and starting a very interesting company actually to design a very early tablet.
Wow.
This was 99 and we were doing tablets. We were not first. This is the thing people think of the iPad as the first one, but really there was a resurgence of tablets that were all like looking at Star Trek for inspiration, that kind of thing, starting around 98, 99 and lasting until about 2000, 2003. There's a very interesting lesson from that for me, I think, for when Apple then launched the iPad. And that was that as a geek, I'm very predisposed to seeing these things that are cool because the idea is cool and not because the execution is cool. And Apple, on the other hand, they're looking at these tablets and no, we're not doing that. The hardware isn't ready. Well, so we had a product that for a geek was amazingly cool. It was a tablet. You could carry it around with you. You could get internet access via it, but it was resistive touchscreen. If you used any of you don't get even the cheapest tablet these days don't use resistive touchscreens because they're so awful. And low resolution, like 32 megabytes of memory. Running a browser in that was fun. And tethered to your house because public Wi-Fi wasn't a thing and fast enough GSM data wasn't a thing. So this thing used DEC to the same standard your wireless uses with an extension to handle the networking. It was shit for consumers.
Wasn't Palm Pad? That was like the first thing that they had a style.
Yeah. So the PDAs, they're fantastic, and you started getting GSM modems for them. So that's absolutely. Ericsson was also experimenting with one that was a similar kind of concept. That was like a tablet, but you were tethered to your house. So
your house or your office is out on the go.
Yeah. So Apple, I think one of the genius things Apple did both with the iPhone and with the iPad was waiting. It was like sitting back and waiting for the hardware to mature. And when they saw the hardware was getting close to going out and solving the remaining issues. Famously, Steve Jobs going to Corning and telling them he needs harder glass. So was one of them. None of the earlier wave of tablets were like all horrible products. They were ranging from things like ours to laptops with hinges that would break and they were still big and bulky and heavy, and those kinds of things. And they were like niche products that was great for techies. And then everybody saw these products selling poorly and decided, nah, this is not the future. And then abandoned it completely while Apple was just sitting there biding their time.
And probably working out some of the bugs.
Yeah.
Like you have to be willing to know that the first version of something you buy is going to be obsolete here pretty quick.
Yeah.
And then just be willing to upgrade as they continue to roll out products.
Yeah, that's one. And that's actually also that's another thing Apple has been really good at, has been conditioning their customers that, upgrading is a good thing. You're getting new cool stuff.
You've been in a number of different startups over time. And if you want to continue to talk about your journey, I'm fascinated. I want to have interesting conversations.
Yeah.
The Stashcast is brought to you by Needle. What if you could use data and analytics to predict real estate transactions? With Needle, you can. Check it out at needle.us to learn more.
What are you doing today and how are you using all of your experience to help others?
Today, I'm running a boutique consultancy, and I'm basically focusing on a mix of DevOps and AI consulting. So on the DevOps side, it is anything from helping people manage the servers to figuring out why they are struggling in various ways and cutting their costs. Cutting their costs is a big part for me because there's old Jeff Bezos quote, "Your margin is my opportunity." So today, AWS is less than 20% of Amazon's revenue, but it's about 70% of their earnings.
Wow.
Yeah, and it's crazy. I jokingly said that I want to devote the rest of my career until retirement to cutting into Amazon or AWS's margins. How much of an impact I'll have on that, I don't know, but it's fun to try by showing people basically how to do that things cheaper. But then especially since I've reignited my consultancy. The other part of it is AI because it's a new hot thing and there are lots of things I can do with it, both in terms of I develop custom tools for my DevOps work and other things and using AI to accelerate it. But then I also realized that a lot of businesses don't have the time to think through it the way I do, because to me, it's a tool that helps me pretty quickly, immediately. So I can afford to invest time in it. And they wonder how they can use AI in their business. Other times it is a question of they might not have a clue of how to adopt it, but they have really massive opportunities.
I feel like AI right now is like when the iPhone came out. Oh, there's an app for that. Merging AI for everything that you can think of. I'm diving into a number of different ones for contacts and enriching those contacts, and then using smart systems and AIs to directly engage with these folks as well. And it's just like part of it
is fantastic.
It's mind-boggling. Yeah.
It's absolutely mind-boggling. And I think also, but one of the things I think we're going to see is that we're going to see quite a lot of those tools disappear because the base models are getting good enough that you can use generic tools to do a lot of those things. And I think this is like one of those things where it's really hard to keep up with everything else happening. So I'm actually finding myself using coding tools that are really meant for developing software to do a lot of these things. For example, if I'm engaging with a new customer now, sometimes I will use, which will record your conversations and produce transcripts. But then I use a generic tool called Code, which is a software development tool. And I've had Claude Code build a skill that lets it download the transcripts. And then I can basically tell it to download all of the conversations with this person, summarize them, create a list of all of the questions we need answered in order to address this thing. Here's the proposal we've sent them, cross-reference and see what's already addressed, expand on that and create files and version control them. And this is something that I'm sure somebody are building tools to do those things, specialized tools, but the underlying Claude model can do this all by itself with relatively little scaffolding. So I think there are businesses being built now that will just collapse completely because they are building a specialized version of a tool that a slightly smarter model will be able to just do on its own, just by being told.
Yeah, and that's the thing with these models. And I've got a couple I use ChatGPT, Gemini, Perplexity, sometimes Claude. I don't use Grok as much. I'm the exact have them test against it, and then I'll cross-reference to try and perfect it.
So it's an interesting one.
That's an interesting exercise to do.
Absolutely. And I think, any of your listeners that haven't done that really should do that, trying to test that out, not least because they have different personalities.
Yeah.
One of the things, for example, I hear, and I've seen this as myself as well, a lot of people will see if they're using these for software development, for example, is that Claude tend to be a lot more impulsive. It will just dive straight in and start doing stuff, fail miserably and iterate. Whereas if you're using Codex, which is the command line version of ChatGPT for coding, it will plan things out in excruciating detail as if it's an academic doing a research project. And those things work well on very different types of things. And sometimes it works well to try a bunch of stuff and then pass what it's done to Codex and tell it, here's a rough and ready thing that probably fall apart if you look at it wrong. Figure out a better way of doing this.
Yeah.
You can have Codex come up with a plan and that Claude executed, because Claude will be much more willing to try things that weren't necessarily covered in the plan. So you get more interesting results by using both, but you need to know the personalities and when it's appropriate to switch.
Yeah. I've had ChatGPT send me down rabbit holes that just end up being time sucks.
One of the things that I've taken to doing there is being prepared to abandon the current context at any time by having the model keep a detailed written log in a text file, update it whenever it does something significant, so that I can just clear out the context, have it start over and just copy in that summary. And if you see it starting to do all the wrong things, ask it to provide a summary and then just copy that into a fresh chat and see if that helps, because then you can edit it as well. Delete if there's anything stupid in it. And
Yeah.
because I think a lot of the things that people often don't think about is that every single past message in that conversation will be in the context. If there are too many, if it has done the same stupid thing 4 or 5 times, there will be 4 or 5 examples of that stupid thing in the chat, and it will be predisposed to look to those as a guideline for what it's doing next.
Yeah.
Even if you told it off for doing it that way.
Let's talk about startups and maybe scaling too early.
Yeah.
What do you mean by that?
I have a concrete example, actually. It was the startup that brought me to the UK. We didn't do too badly. We held back for a while. So basically that startup started out as a vanity email service. It actually morphed into launching the .name top-level domain eventually. So that's the legacy of that company. But we started out as a vanity email provider, so you could get your last name dot something or other. We bought 60,000 domain names for the most common last names in the world. And basically had people register their first name at. We grew at a reasonable rate. When we sold off that to pivot to the .name top-level domain, we had about 2 million users. And at the time, that seemed like a lot.
Yeah.
We had the total memory capacity. Everything was less than my laptop.
That's insane.
But at the time, we went from starting out with quite modest hardware to thinking, oh yeah, we need to scale now. And we did need to scale. We started looking at storage systems and was seduced into buying this massive IBM enterprise storage system, the size of American-sized bridges. It was a fantastic piece of hardware. You could fire a gun through that thing and it would keep on running. And it might call IBM and tell them to send somebody to fix it, because it actually had its own modem and would actually call out for assistance. So the first thing you might know that something was wrong might be an engineer at your door saying, hey, we're here to service this thing. It would have set us up in terms of scaling to 10 times where we were. And in retrospect, it didn't kill that business, luckily, but it easily could have. Making that kind of investment was unnecessary. We could have continued growing with cheaper hardware for a very long time. And I've seen this happen with a lot of startups where they're like, oh yeah, we have this growth now and we are assuming this growth is going to continue. And instead of doing incrementally growing capacity, we are now looking at planning 3 years ahead and buying the stuff we will need at the end of that 3-year journey. But the problem, of course, is we're looking at a venture funded startup in particular. Actually, and I did modeling of this when I worked for a VC a few years back. The most successful startups will raise again in less than 2 years, usually less than 18 months. So if you want to be among the most successful startups, you're planning for a growth trajectory. That means you will run out of money within 18 to 24 months. There's no point in planning for the case where you are going to be, if you take VC capital, and this is actually one of the reasons why I now prefer bootstrapping myself. If you're taking VC capital, that is the kind of growth trajectory your investors will want, because they want you to go 10x, 100x, 1000x. They don't want you to grow 20% year-on-year, because that will never get them the multiples they need. If you're going to do that, you need to be very mindful of the fact that capital now is a lot more expensive to you than capital after the next round, because if you are getting that trajectory, really, you want to be investing in hardware and in solutions that will just get you over the funding, just get you to the point of the next funding round. And a little bit further, because you need to have time to then invest, buy more stuff, and get you the next step. You don't want it to be stuff that lasts you 3, 4, 5 years, because then you're spending a lot of money now where the cash is costing you maybe 20-30% of your company at a valuation that is hopefully several times higher down the line.
So if you think you need this big piece of hardware, it's better to lease it than go all in and buy it, because the lease offers a lower kind of entry point.
Yeah, absolutely. And this is the promise of clouds. This is why Amazon is getting away with their pricing as well, right? It's why they're promising you don't have any commitment. You're buying for minutes, seconds. But the reality is that most people do end up buying things slowly or ramping up slowly as they're growing. Very few people grow fast enough that they can't at least lease or rent.
Mm-hmm.
And even Amazon itself, if you're going to cut costs with Amazon, one of the first things you need to look at is basically making the pre-committing cash with savings plans and stuff like that. And you get steep discounts from them because obviously you're locking in the cost for a long time. But if you're doing a startup, especially if you're doing a VC-funded startup, you're not going to get into a situation where you're going, hang on, we're only going to need 20% of the capacity next month. You're not going to do that. You're going to run full tilt into this, try to get the growth. If you're not getting the growth, you're going to be running out of cash very quickly anyway. So obviously, you shouldn't commit for a year if you need some extra hardware to handle a brief spike. The vast majority of the time, you're not dealing with spikes. So you need to be planning for your base load, and you need to be planning that to be cheap. And then you can spin up stuff in a cloud provider. If you're suddenly featured on the front page of some major newspaper or TV channel and you get a load spike and you need to spin something up quickly, it's great to be prepared to be able to spin things up in a cloud provider. But most of the time, slow, boring, getting managed dedicated servers, building that up slowly is much cheaper.
It's a paradox, right? Because if you're taking VC capital, and I'm curious to hear your perspective on that, essentially, and the reaction we got was, hey, it's a great solution. We need to see more users. So I'm in the chair of going out and knocking on doors or creating workflows to be able to drum up conversations.
It's a big dilemma. The first issue there is what kind of investors you're going for. And if you're going to a VC fund, is basically looking for fund returners. They want companies that are promising. They know that most of them won't deliver, but they want companies that are promising and where it looks somewhat plausible that they can go 100x at least. So they want to be able to invest in that company. And if that company does what they are saying they will, then that is covering the entire fund if all of their other investments go bankrupt. Now, obviously, not all of them are going to go bankrupt. It's going to be nothing of interest. But then you have these outliers. The outliers are that's what they're looking for. And so they are looking for that. You're selling them on that hope of going that way. Now, thing then is that the moment you start getting users, if that user growth isn't following a massive hockey stick, you shot yourself in the foot, because before you were starting to get users, you could sell them on the hope. Once you start getting users, you better hope you're getting them quickly. I mean, in that situation of, well, we started getting users and the trajectory isn't at all what we were hoping for, then you better hope that you're getting that hockey stick and that it will just take off and go vertical very quickly. But most of the time it won't. So in reality, most startups fail. If you don't want to make it big or fail fast, you need to look for investors that are fine with a 20% year-over-year growth or even less, that are like, okay, I want you to build a lifestyle business. When I was working at the VC, we were all filtering pitch decks. I saw so many founders that were coming to VCs and saying, hey, we can go 5 times. Most of them didn't dare say 100 times or even 10 times. Worst case, we can do like 50% of that growth and then we can exit. And they were like instantly binned, because this isn't something a VC wants to hear. This is something an angel investor might be happy with that. So that's like, sure, making 50% return on their investment. Hey, sounds good. If you are making investments that you believe in and that are relatively small and you're not betting, a VC will typically promise that this time they're going to manage like 30-40% year-over-year return after their management fees and their carry, right? And it's like, you can't deliver that without taking some absolutely outrageous bets. And most of them don't deliver that. So they're selling on the dream to start with. And you cannot then go to a VC and tell them that you're dreaming very small compared to what they're expecting.
So you essentially need to gamify your pitch to VCs.
I think this is actually one of the things I would be happy to take VC capital again if I suddenly have an idea. Yeah, I'm going to spend 2 years and try this out. And if we don't raise the next round, that's fine. I actually had one of the startups that I was involved with about 20 years ago now was co-founded by, first or later was chairman for the VC fund that I joined. Basically, that company, the assets were sold off for a pittance, despite us having an offer on the table from one of the existing investors, because it was like, okay, this offer is so bad that we can't make it big anymore. So what's the point? Let's sell this up and move on. And I respected that because it was like very much, okay, we know this is a long shot. We're trying to do it big. And we are telling everybody, if you're not getting this, if you're not going vertical, basically, then we're closing down. So sold off the assets for a pittance, and that was it.
Wait, so the choice was sell it as a whole for a larger number, but a number that wasn't what it...
So basically, the alternatives was take this is several $1 million. I think the potential investment would have been more than sell some, but that was an investment, right? It would have diluted original shareholders further, including the older investors. This investor had waited until the last minute because they knew that they could dictate worse terms and put an offer on the table that would have allowed the company to survive and maybe grow, but it would have meant that even if we grew as we hoped we would, at that point it looked like our trajectory would probably be significantly worse than we hoped. Then nobody else would get the kind of returns they were hoping for because everybody else would be diluted so much. So the alternative was just selling it off and everybody would get money back in the proportion to what they put in. And that actually was like, it might have been marginally worse for some, but the alternative was potentially spending several more years knowing that we would not get a fair return from it because we'd already been diluted. This dilution actually is one of my other pet peeves when you're seeing people bragging about 8-figure exits on LinkedIn. Everybody gets really excited. Most of the time, if you're looking at exits in that kind of size from a venture-funded company, that probably means they had done really badly and the founders have been pretty much diluted out, next to nothing.
Oh my gosh.
I had 25% of the company when we started. But the company did more investment rounds, people got diluted more and more, and eventually it was sold for 10 million. And I got 10,000.
That sounds like a nightmare.
Yeah, it's a nightmare. But this was a company that did not perform well. It did not make back money for the earliest investors. So in the end, it was not that it was an unfair result for me, for example. I had cut my losses early and left and moved on to something else. If it does not grow fast, the terms are going to get worse and worse, right? Because the risk is higher. The chance of making a return is going to be worse and worse. So they start piling in additional terms, like liquidation preferences and stuff like that to safeguard their investments. And it's reasonable. The alternative is not to put the money in. But you should be aware of that as a founder, because even when you're looking at companies that do well and go to IPO, companies that end up going to an IPO, the founders will have been diluted down to 30% of their bonds. And those are successes. Those are big successes. It's very rare for the founders to be left with as much as they were in those kind of companies. Or I go down the road to the next VC office and sign a deal with them because everybody's after them.
I guess it makes sense.
It makes sense to the sense that, yeah, there are predatory funds out there that will speculate in this, that will drag out deals. They will see an inexperienced founder a long way, shop around for multiple investors, even if somebody's putting an offer on the table, because some of them will speculate in the fact that if they're the only one on the table, they can wait until this company is close to running out of cash. I've had investors like wait until 5 days before we could make payroll to sign a deal. And sometimes the investors in those kinds of situations will use that as leverage and will suddenly come to you when it's 5 days before you can make payroll and say, oh, sorry, the terms have changed. Thankfully, in the case I mentioned there, we had an investor that came 5 days before, didn't do that. But you put yourself in a vulnerable position if you don't have fallback options. And so, yeah, a lot of the time it is simply down to, obviously, they need to manage their risk as well. They're putting millions in potentially. And if this is a company that isn't performing quite as hot as what they were initially promising, then the terms needs to reflect that. And they need to safeguard, well, what will happen if the growth continues to be slow.
I wonder if there are solutions that could have been really beneficial or really helpful to the market that they serve, or even mankind in general, that are now on the cutting room floor of VCs.
Yeah.
What's the impact of that?
I think it's huge. And I think sometimes you will find founders revisiting ideas. I'm in that scenario now. And there's a confluence of several things I've worked on in the past where I'm thinking, yeah, it's not necessarily the product we were selling, but it might have been part of the technical solutions where I'm thinking, yeah, those ideas were actually really good. And we didn't have a chance to publish anything around it. I can't go back and use the code, but the ideas are in my head and I can evolve those. So there is a bit of that. But I think, yeah, a lot of the time these ideas will end up getting scrapped because they're not published anywhere and nobody wants to revisit them, sometimes because people are burnt out and sick and tired of the whole thing. Because like with the tablets, for example, where this industry decided pretty much collectively that no, there is no money in this. And thankfully in that case, Apple reignited it. But that could have very easily ended up the same way with these other founders just going away and doing other stuff.
It's such a quandary. It's such a dirty business.
I think a lot of the time it's founders are partly to blame for deciding to get seduced into it or letting themselves be seduced into it. I said that I didn't have any regrets with respect to any of the startups in terms of I don't regret having done them, but there are certainly decisions that were made in those startups that I regretted. And for example, this vanity email provider that I mentioned, there's two things that stood out to me as things I regret. One is we were seduced by the VCs into thinking we should aim for customer growth at all costs. At the time, this was in the ramp up to the dot-com crash, users, whether or not they were paying or free, was measured at attractive a ridiculous multiple. I remember in particular, there was one company that was sold for a multiple of $4,000 per user. And obviously they were looking at this and going, hang on, why are you going to be charging your users? Why don't we make it free instead? We make sure that you raise enough capital that you can make it free. You can grow your user base as much as possible and get the valuation up, and then raise more money, get more users, get the valuation up, and then we can figure out how to make money. And that seemed very appealing, but basically it was gambling. It was gambling on the growth continuing. And we started raising money in 99. We moved the company to the UK because the Norwegian VCs were basically saying, we won't be able to get you enough cash for the next round. So we moved to London and we raised the second round. The market crashed a few weeks later.
No.
The money, and we were among the lucky ones because the money that was meant to have been spent basically over the summer ended up being what kept the company alive for the next 3 years. It was while we refocused, ended up selling off the mail part and refocused on the .name top-level domain. So the first decision I regretted there was doing that. I think we would have been better off in terms of building a business slower, finding smaller investors and sticking to what we did. Because the second decision I regret was selling off the mail part. And I was the sole vote on the board against it. I was on the board as the representative of the founders at the time. All of the investors voted against. They had a majority on the board. And we sold it off for a couple of million. The buyer was a company that at the time was owned by Mark Cuban. They had done the slow growth thing in the same space. And they bought this for a couple of millions. It took them 6 months to make that money back by basically telling the users that they're cutting the free service. You can convert to paying users or leave. And they lost 94% of the users. The remaining 6% was enough to pay it back in what they had paid for it in 6 months and pure profit afterwards. Had we then looked at that and said, maybe we should start cutting back or even closing the free service, done the same thing, that business would have been much healthier. I think I still learned enough from that startup anyway that it was worth it. I came out of it. I wouldn't have gotten the jobs that I got subsequently without it.
Yeah. Talk to me a little bit about the gaining of users at any cost, because we're in a position where we're putting our solution behind a paywall.
Yeah.
Are we doing the right thing?
I think there are places where sort of premium type services can work with a free service where you're pushing users hard towards upgrading. What we did of having a free tier, I think for the vast majority of users does not work very well. Such a large percentage of them are going to be users that have no incentive of ever upgrading. I think if you are going to go for that kind of premium model, your initial tier really probably should be marketed as, well, this is effectively a trial. You are, whether or not it's possible for you to continue using it, it needs to be so hampered. If you're allowed to continue as a free user, it needs to be so hampered that this is not attractive other than as a way of testing if this works.
Yeah.
I think that kind of model that we use there of going fully free and then just trying to add on some upsells later only really works in the VC world where the goal is to grow that user base at any cost. And if you're going to grow that user base so huge that everybody gets to know about you, and then you are prepared to raise another large amount of cash to tide you through as you're shedding the vast majority of them to try to convert them into paying users by getting more and more aggressive, maybe it'll work. Maybe it'll pay off. Maybe you'll manage to sell it to some other sucker. But so from a VC point of view, if you manage to exit, it doesn't matter what happens afterwards, right? But I don't feel good about that kind of model. It was easy to talk me into that when I was, let's see how old I was, 24 at the time. And this was like, you're looking at an investment of about $1 million, $1.5 million maybe. But it's not so attractive anymore. Especially because I know that $1.5 million of investments does not mean you're going to get a huge exit. At one point, we were looking at, in Norwegian crowns, right? We had a valuation of 300 million crowns. And it was like, this sounded like an astounding amount of money when you're in your early to mid 20s. And we're riding high on that without thinking about how much dilution is going to happen before we get to sell. That valuation crashed when the market crashed before you're going to be able to sell. Since then, I've become a lot more cynical about the value of shares in a startup. I'll discount them by like a factor of, they're worth like 1% or 0.1% to me until I start seeing traction. Yeah. And even then I will be very skeptical. People often get offered shares and it's being used as a leverage to get them to accept a lower salary. And the last time I accepted a lower salary, and even then it was temporary, was with that company 26 years ago when I founded it. I actually held up the signing of the first VC deal until I got a clause into the contract that required them to raise our salaries after 6 months. And I did that because even then I was like, yeah, this is still, I might have stars in my eyes about this is a huge amount of money right now. But I also started coming to the realization that this is gambling in a sense. The risks are high enough that you should be getting paid pretty much the same as pretty much a market salary while you're working a startup. As a founder, it's a little bit different. If you're getting at that point, I had 25% in that company. I still insisted a drop in salary for about 6 months before we be back up where we were. These days, I'm going in, if a startup wants me, I will make it very clear that this is going to be a market salary, do some stuff for equity only part-time. But if they want me full-time, it's okay. This is a market rate salary. The shares are a compensation for the extra risk I'm taking.
Yeah.
You need to think, in that case, you need to evaluate it as an investor. But you are a stupid investor because you're putting all of your investment in a single company, whereas your VCs are going to be putting their investment in 30 companies, spreading the risk.
How do the best VCs function and help their portfolio companies scale and build?
So I think obviously when you're getting at the very high end, you will get VCs that are extremely well connected, and that's what we have. I've been fortunate enough to be involved in some startups that have had some extremely well-connected, small-scale angel investors, but people who are extremely well-connected. One of the companies, for example, had a guy called Ron Conway as one of the angel investors, and he is like an early investor in Google, lots of other companies. He could pick up the phone and get to anybody. And if you get that kind of caliber investors, of course, it's going to open doors. So that's fantastic. But also, they're not going to spend a lot of time on you unless you are actually one of showing signs of moving in the right direction at the very least. You will get some time initially because obviously they want you to do well. But if you're not delivering, you need to deliver for them to invest more time in opening those doors, because otherwise they're wasting their time. They can spend the time on a company that's moving 10 times faster than you. They will obviously choose that. Investors are not going to be spending a huge amount of time opening doors from you that you couldn't open yourself. If they have another portfolio company that'd be a great partner for you, a great customer for you, they'll do that. But the reality is that a VC isn't... I went into this VC that I worked for thinking that, oh yeah, they're swimming in cash. They had a £100 million fund, a massive amount of money. But the maths of it is obviously that a VC fund is getting 0.5% to 2% of that in management fees. They need to live off that. And then you need to look at the maths, because we were receiving hundreds of pitch decks. So we were 15 people in our fund at peak. And we were all reviewing a huge number of pitch decks every week. Most of the company was portfolio managers that could be traveling around, meeting potential founders, talking at events, getting connections to get the inbound deal flow, because otherwise you needed good enough founders to find us, because otherwise they would go to the competing funds. And of those hundreds of pitch decks, many hundreds, might have gone into the thousands, we placed a couple of dozen investments. And from those couple of dozens investments, we will be getting management fees. And if they performed as promised, then after the investor has made back their money and a certain yearly return, then we would get 20% of what was left in carry. There was no guarantee of that, and that wouldn't be due until exits. So you needed to be able to live off those management fees. In many cases, you'll find that most people, or at least the senior people in that fund, will have put in a lot of their own personal money. So in our case, our contracts basically required us to put in a 1 year salary into the fund.
Wow.
And we were lucky, we got the money. So the fund basically ended up getting sold in its entirety to one of the investors. And so we got a small return on our initial buy-in. It remains to be seen whether we get any carry, because that fund is still not closed.
Out there.
But I think, yeah, VCs generally, most of them are not rich. The small percentage who manage to raise new funds over and over, Andreessen Horowitz, Planning Perkins, those kind of funds that have a track record that is so fantastic that investors keep putting money in a new fund, they manage to build up. They have survived through the point where they will carry, and then you're rich. But most funds never raise again. That's the first thing. So it is only that some of the principals will go on to fund another fund. The fund as a whole doesn't survive to build up those reserves. That was a shock to me when I started, because I was like, VC fund is we're printing money. We can just spend. We don't need to worry about that. And I joined, and I was like, well, okay. So this is the maths. This was not what I expected. It's a regular business, effectively. And it's a relatively low margin business, in fact, for the majority of the duration of the fund's life. And then maybe there's a big payoff out there.
Yeah. So would you rather be a founder or a funder?
I would love to get that big exit that was big enough that I could put small bets in as an angel. I think it was an interesting experience working at the VC, and I wouldn't rule out doing that again as well, but I would approach that as a regular job. I would basically discount the potential carry to near zero and just assume that, okay, I'm taking home a salary here. That's it. So I think in that respect, if I was working at the VC, I would prefer to be a founder. But prefer to do what I'm doing now, which is basically bootstrap, while I have my projects that I'm slowly bootstrapping in the background and not talking too much about while I'm doing my consulting.
Yeah.
And that I think suits me better because it's a low risk. It is slowly paying off a bit. It's not going to make me a billionaire, but it could get me enough for a chateau in the south of France. Which, by the way, it's a standing joke because a chateau in the south of France costs less than a flat or a house in London. But you need enough money to maintain it.
This has been a fascinating conversation.
Keep the hope. As I said, I've never regretted any of the startups. Some of them have been long slugs, but I feel like even the long slugs, sometimes the issue is you need to know when to cut your losses and move on and do another startup. But I didn't stop doing startups because I think the experience has been fun for starters. It's mostly fun. And even when you end up having to close up shop or end up selling it for pittance or you sell it for a decent amount, but your investors get all the money, you still come away with a lot of experience. And I feel like my career trajectory has been largely driven by having a very sort of unique experience. I still remain very hands-on because when I do a new startup, it's basically like a reset. It's back to the floor, doing everything because you have to. And also doing things that you never thought you'd be doing. Like in my first startup, I did phone sales. It might not sound like this here, but I'm very much introverted. And so when I'm talking about something I'm excited about, I can talk forever, but it drains me. And doing phone sales for hours on end, it was absolutely brutal.
Yeah, that's a
But
grind.
now I know how to do it. And I would never have learned that in a regular job because I was never applied to a job that involved doing that. And at the same time, from having done all of those jobs on the floor, from doing like phone sales, doing support calls, phone support, absolutely horrible. Somebody's got to do it, to board level, right? And talking to investors, reporting to the board, being on the board. So you get a much broader span than most people get. That's been valuable. It's helped me get positions, work on things that I never would have otherwise.
Yeah, I use a quote all the time from my wrestling coach when I was in high school. And he knew that we were going to get our asses kicked, that we were up against a much better opponent. He'd be like, now this is a learning experience. That's true. You do get learnings.
Absolutely. It's a very good point because I feel like a lot of the time people are looking to the big successes for learnings, right? But they have played it on easy mode a lot of the time. Some of them haven't. Some of them have really gone through the ringer. And some of those founders have failed many times first before they got it. But some of them just happen to get it right. Some of that is almost certainly a skill, but there's also a lot of luck involved.
Mm-hmm.
A lot of the time, I find more valuable lessons from failures and how people have dealt with them. Because if you have managed to weather a failure, you will have learned so much more from that than having it easy and smooth sailing and your sales just took off. If your sales just takes off because everybody loves it, you're not going to learn how to sell properly and overcome objections and work through all of that, right? So that's great if that sales continue going upwards and you manage to exit without having ever needed to do hard sales.
Right.
But if it suddenly gets hard, you're going to wish you had those lessons at the time and you had the time and the luxury of being able to learn it properly.
Yeah, of course, everybody, the choice is going to choose to have the easy path, but you're not always going to get that choice. So.
Exactly. Getting the easy path and then going full speed into a wall is not fun. And so I would prefer to have some learnings first and know how to steer clear of the wall. So it's great if you can get the easy path all the way to an exit, but
does not always happen.
No, it rarely happens.
Yeah.
The odds are not in our favor, unfortunately. So I think that's the upside of being a VC. You get to spread bet on 30 investments at a time. Whereas as a founder, you have to do it in one after the other. Odds are you get better at it each time or over time within the same startup and you figure some things out. I'd like to think I know more now than I did when I did my first one.
If somebody's interested in reaching out or engaging with you for your services, consulting, things like that, what's the best way to get in touch?
My website has details at hokstadconsulting.com or look me up on LinkedIn. I'm in the fortunate position of having a globally unique name. The downside is that I can't hide. right? I can't
You and me
pretend
both. Yeah.
exactly. I can't pretend the Google results aren't about me.
This has been a great conversation. I really appreciate it. I know it's late for you, so thanks for hanging out on a Friday night for me.
Thanks for having me.
All
It's
right.
been fun.
Okay.
Thank you.
Bye.
That's it for the Stashcast. Subscribe, share, and stay ahead in commercial real estate and prop tech. See you next time.